Today we're unpacking the story of Jinnan. It's a fascinating case study of a company that has completely re-engineered itself, shifting from a straightforward software vendor into a fully integrated fintech platform. We're going to break down the strategy, look at the hard financial evidence, and examine the massive market expectations that are now driving this company forward.
So, what's the big picture here? The entire story really boils down to 4 key takeaways. First, you have a radical shift in the business model. Second, the company is executing a very specific strategy known as one body, two wings. Third, the financial results show this classic J-curve pattern, a sharp dip followed by a really powerful recovery. And finally, all of this has led to a market valuation that is pricing in some exceptionally high expectations for future growth.
Okay, so to really understand Jinnan's journey, we have to start with its strategic blueprint. That's the one body, two wings model. Now, this isn't just a random string of acquisitions. It's a very deliberate architecture, designed for acquiring users and then monetizing them deeply.
The power of this one body, two wings model is really in its elegant simplicity. Think of it as a strategic funnel. It all starts with a core service, that's the body, which is designed to attract a massive user base. From there, the goal is to systematically guide those users into higher value services, and those are the two wings. And here's exactly how Jinnan put that theory into practice. The body is their established financial analysis software, which acts as a huge magnet for users. The first wing came into being when they acquired MyGao Securities, which let them start converting all those software users into actual brokerage clients. And the second wing, the acquisition of Pioneer Fund, is all about deepening that relationship by offering wealth management. It's a very clear, logical progression from one stage to the next.
Now, a strategic shift this massive is going to leave a very clear footprint in the financial statements. And in Jinjan's case, it absolutely does. It shows up in the form of a very distinct J-curve.
This table right here tells the whole story of the transformation. Just look at 2023. You see revenue and net profit both take a major hit, down over 11% and nearly 79% respectively. That's the bottom of the J, that's the pain point, the period of heavy investment and integration costs. But then, watch the rebound. 2024 shows a very strong recovery, and the first half of 2025 is where you see explosive growth, with revenue up over 71% and net profit just soaring.
However, it is absolutely crucial to add a bit of context to that incredible profit number for 2025. A pretty significant chunk of it, about 65.5 million CNY, came from a one-time accounting gain tied to the Pioneer Fund acquisition. Now, the underlying operational growth is still very strong, but this non-recurring item is a really important detail to keep in mind for understanding the true performance of the core business.
So to really understand the change in the company's DNA, we need to go deeper than just the top and bottom lines. And for that, we're going to pop the hood and use a tool called the DuPont analysis. It's perfect for this because it breaks down shareholder returns into its fundamental building blocks. This table reveals the fundamental rewiring of Jinnan's entire business model. Before the big shift, back in 2022, it looked like a classic software company. High margins, low leverage, and a very strong return on equity of almost 23%. But the years that followed paint a completely different picture.
First, just look at that dramatic drop in the net profit margin. It goes from a very healthy 27% all the way down to under 7%. Now, this isn't a sign of failure. This is simply the mathematical reality of shifting from an asset-light, high-margin software business to a capital-intensive financial services business like a securities brokerage.
At the exact same time, look at what happens to the equity multiplier. That's a measure of financial leverage. It more than doubles, going from about 2 to over 4. This reflects the new business model's need for a much larger balance sheet, which is a core characteristic of any brokerage platform. So the DuPont analysis is telling us a very clear story. Jinnan made a conscious decision to trade its high-margin, low-leverage software profile for a low-margin, high-leverage platform model. The future of its profitability now depends much less on margins and much more on achieving massive scale.
This profound transformation has definitely not gone unnoticed by the market. And to really get a handle on how the market is pricing this new version of Jinnan, we need to put it in context with its peers.
In the Chinese market is a very clear pioneer of this business model, and that's Oriental Fortune. They basically wrote the playbook that Jinnan is now following. And understanding this dynamic is absolutely key. Oriental Fortune is the mature, established leader, while Jinnan is the challenger, currently in a much earlier and much higher growth phase of executing that exact same strategy.
Now, when you look at the valuation multiples, the market's expectations become crystal clear. Shinhan trailing price-to-earnings and price-to-book ratios are orders of magnitude higher than the mature Pioneer, Oriental Fortune, and other peers. These figures objectively show that the market has priced in a tremendous amount of future growth.
So given this setup, what are the key factors that are going to determine if Shinhan can actually meet these high expectations? Let's take a look at the potential growth drivers and the significant headwinds it's facing.
On the growth side of the ledger, you've got 4 major catalysts to watch. The integration of Pioneer Fund is arguably the most important, as it opens up the incredibly lucrative wealth management market. The company also stands to benefit from favorable regulatory policies that support fintech. Then there's the potential to leverage AI, which could be a key differentiator. And finally, a planned capital raise of 3 billion CNY would provide a serious amount of fuel for expansion.
But the path forward is never a straight line. The entire fintech sector operates under a microscope of regulatory scrutiny. The business is also inherently tied to the health of the capital markets. There's significant execution risk in trying to integrate 2 large, complex acquisitions at the same time. And of course, the competition is fierce, with both the established leader and traditional firms fighting for market share.
And all of this brings us to the central tension in the Shinhan story. The strategy is clear, the playbook has been proven by others, and the initial financial results show a really powerful turnaround. And yet, the market's valuation implies something close to flawless execution and sustained explosive growth for years to come. So the question really isn't about the past, but the future. Can Shinhan actually grow into the immense expectations that are already reflected in its price?